Hello there, everyone. Welcome to our latest episode of the Market Misbehavior podcast. My name's Dave Keller, and I'm so glad you're joining us here on today's show. Our goal with the Market Misbehavior podcast is to sit down with top market practitioners, strategists, analysts, educators, authors, money managers, traders, anyone who has some good experiences in the financial market, some insights and expertise to share with us, and some lessons learned that we can use to improve our own decision making and market perspective. Really interesting guest today, Nick Raich. Nick is the CEO of the Earnings Scout. He's based in Northeast Ohio, and a number of years ago, before we relocated to the Pacific Northwest, we lived in the Cleveland area, not far from where I grew up on the west side of Cleveland. And a mutual friend, Scott Richter, who is the former president of the CMT Association, introduced us, and I'm so glad he did. Nick's a really smart guy and a really knowledgeable investor, has experience digging into earnings from a quantitative perspective, and his firm, the Earnings Scout, is all built on his unique and proprietary way of analyzing changes in earnings estimates. I followed Nick's work after we met. I've kept in touch with him, I've been able to interview him over the years, and I found he often has does a brilliant job of highlighting when there's a disconnect between market action and earnings. One of the first things I asked Nick in our interview was about that traditional relationship. I was taught in my Fidelity days that price follows earnings, and we started off there and then went through a fantastic journey of going through all things earnings. What you'll find is Nick's unique way of looking at it through his work at the Earnings Scout looks for what we call alligator jaw patterns, where there's a disconnect between price action and the changes in earnings estimates. And major peaks often happen, and February of 2025 was no exception, where the trend in market prices is going higher, but the trend in estimate revisions, the change in estimate revisions, is going down. And that divergence, or what he calls an alligator jaw, is often a sign of a dangerous environment. That fired in February 2025 was a fantastic signal. From there, we talked about how estimate revisions have changed. We talked about the improvement in the change in estimate revisions off of the low, and how in recent years, even though estimates have been underwhelming and projections about earnings growth have been underwhelming, the rate of change, which is what's so important according to Nick's work, have been quite helpful and have helped to keep you on the right side of the markets. We finished off talking a lot about current market conditions, the tariff impact on earnings, him making sense of this Q1 earnings season that we're just wrapping up here, an outlook looking forward and what sort of key things he's looking at, offense versus defense, growth versus value. And I thought he had some really good insights at the end, talking about where he might be seeing some opportunities going forward. So a great conversation with a knowledgeable investor. Please enjoy this interview with Nick Raich of the Earnings Scout. So I'm super excited to be sitting down today with Nick Raich of the Earnings Scout. Nick, shout out to Northeast Ohio. Good to reconnect with you. We met when I was living in the Cleveland area, and I'm really glad we've kept in touch. Super excited to get your take on the markets here. But thanks for coming back on the show today.
Thanks for having me back. Great to reconnect.
So listen, I want to talk about some of the specific conditions that we saw going into the February peak. I want to talk about what's happened since then. But if you could start us a little more broadly. I was taught in my Fidelity days, I had a bunch of portfolio managers I was working with that told me price follows earnings. And by following earnings, that's how you get the sense of where the trajectory of where your expectations should go. Can you talk a little bit about that relationship and specifically how you're trying to understand earnings trajectories going forward?
Right. And I do believe that price follows earnings, and price is something to look at too. My whole career has been just over the last 30 years. I started out as an earnings analyst at Zacks Investment Research in Chicago. Started there, analyzing earnings, and learned how they impact stock prices. And Peter Lynch was one of the guys I worshipped and tried to follow, because he followed earnings as well and was using the Zacks data at the time. What I found, though, is that you can be led astray. There's a lot of different sets of earnings. You have GAAP, you have non-GAAP, you have the past earnings, the current earnings, next year's earnings. So there's a lot of pieces of the puzzle that are jumbled out there that confuse people. And if you look at earnings in the wrong way, it can lead to inferior conclusions. So what we found is, and it's a very simple thing, is stock prices don't follow changes in earnings estimates. It doesn't matter if the estimates are going up or down. What we found is over time is they follow the rate of change to earnings expectations. So that's what we're doing. We're looking at the direction and magnitude of the estimate changes, higher highs, lower lows, very similar to what technicians do on price. But we're applying that to the earnings and then looking to see, are the expected earnings getting better or worse? So again, it doesn't matter if estimates are going up or down. It matters if the estimates are getting better or worse. And that's how we look at it on a rate of change basis to see that.
It's so interesting, and I know from following your work for a while. I mean, it's brilliant how that helps you understand sort of how expectations are evolving over time. Why do you feel? I mean, because that just simple way of considering it is a way that I hear very few people talking about. Why do you feel like most people kind of miss that basic relationship? And honestly, I feel like too often we're thinking about like trailing 12 months earnings as if there's some predictive value to that. What do you think? Is it just a lack of understanding of the data? Like, what is it? Why do you think so many people miss that reality about the relationship between earnings and price?
I hear a lot of people talk about, oh, it's about rate of change, and they get the concept, but then there's something kind of core in our nature to see a company where the earnings estimates are going up and you're positive on it, but failing to see that the estimates are going up at decreasing rates and it's losing momentum. And it's
Yeah.
very difficult to see a company where the estimates are getting cut and be positive on it, but yet not notice that the estimates are getting cut at lesser rates and improving. So I think a lot
Mm,
of people are just hardwired to be first level thinkers, estimates going up or down, good or bad. In stocks, you need to be a second level thinker. You need to see, are they going up at increasing or decreasing rates? And I think the best investors that I see follow rate of change. And if you're not, you really miss whether the trend's getting better or worse. And you really need to see that when you're investing in a company. You need to know, is the expected business getting better or worse? And I don't
mm.
think you don't know that going in. I think you're flying blind.
It's so interesting because I know, I mean, in my experience working with money managers, and you do it more often now than I do, but we often talked about trying to get to that second level. There's too much the first level thinking, the simple relationships pretty crowded. If we can get to the second level, really understand things a little better, then we have an advantage. Then we have a potential to outperform. You have some charts that you brought with you, Nick, which I'd love to sort of get through. This first one really talks about the alligator jaw, which you refer to often in your work when it sort of emerges. And this was a chart you shared, really describing the conditions going into that February peak of this year. Can you talk about what the data showed you going into that peak, and what that sort of implied about prospects going forward?
Yeah, so this chart goes back to where the alligator jaw opened up twice, and let's say what the alligator jaw is, and it goes back to, you can see there late 2021 where it starts, or at 2020 actually is when COVID shutdowns were going, estimates were going up at increasing rates. So we have an earnings score there, and right where you're showing that chart there, in each earnings season, when peak revisions come in, we measure the overall expectations for all 500 companies in the index and seeing how they're going. And we have an earnings score that's above that zero line, a positive score, that's telling you the estimates are going up on an absolute basis. The score tells you the magnitude. And you can see it looks like peaks and valleys there. That's because most of the companies all report within a 1 or 2 week period. So when they report, the estimates are going up, and then there's no more companies reporting it, the line drifts back down. But if you look there in late 2020, the estimates were going up at increasing rates for 3 consecutive earnings seasons. When we've had estimates go up on an absolute basis at increasing rates, over the last 40 years of data, we've never had any correction in the market of any kind. The stocks always go up in that time frame. But then how we measure an alligator jaw and what we define there, you could see in late 2021, after everything was going up, the estimates started going up at decreasing rates. So you get negative delta, and then we can see where it's going down. And when that happens for 2 quarters in a row or more, where we get weakening on a rate of change basis earnings expectations for the S&P 500 here, and the stock prices keep going up and up and up, that's a divergence that we define with an alligator jaw. So you think about it, it's half a year where the expected profitability of companies are getting worse and the price keeps getting higher. That has happened 7 times over the last 40 years. And the chart to the far right there, you can see this was all the way to February 21st. So the market peaked on February 19th. You can see an alligator jaw opened up just before the last, this 19% peak to trough sell-off from February 19th to April 8th of this year. And those 7 times, the least negative drawdown we've ever had when a jaw opened was a 13% drawdown on the S&P 500 in 2015. And all the major bear markets, a jaw was open before the dot-com collapse, the financial crisis, before COVID. And you can see here, just over the last 5 years here, that in charts, the last 2 times the alligator jaw opened, we had a 23% drop in the S&P 500 and a drop of 19%. Now, the jaw is now closed, so that is good in terms of the jaw closing. But what we think that represents best is a market that's pricing in perfection, and any negative variable that comes out, it can be detrimental to stock price. For example, the negative variable here was Trump putting on tariffs across the world all at once, which was very disruptive. The fact that we had an alligator jaw, there was mismatched valuations and overvaluation because of that intensifies the sell-off, if you will. If there wouldn't have been a jaw open and Trump does those tariffs, maybe we go down 5 or 10%, maybe not 19%. So that jaw represents a disparity between the estimate trends and price. And the core concept of what we believe is stock prices follow the rate of change to their earnings expectations over time. And when we see that divergence, it's happened 7 times. The alligator jaw is now 7-0 at predicting major corrections and bear markets. So what I found interesting, though, Dave, is this. In the 40 years of data, we've never seen a reverse of this alligator jaw happen. And the reverse would be, have we seen 2 quarters in a row of improving earnings estimates and falling share price? Never happened. Has never happened. So the market is inherently biased to go up. When earnings estimates improve, people get excited and want to invest. We've seen things get overvalued. It's very hard to see that reverse. We've seen individual companies happen. And this happened too, where you get improved earnings and falling price that we think are great buys to get into, that the market's pricing in the worst. And there's really no more negative news that can be announced. So you got nowhere to go but up on the stock price. But at the index level, we've never seen a reverse of the alligator jaw. So that sets the stage for where we're going. And in the middle of this chart here, I want to highlight something here where you need to be a second level thinker. We know that the market had a peak to trough 23% drop in 2022.
Yeah.
The bull market, which went on life support in April, it almost died, but the bull market survived. But it was born on October 12th, 2022, when the estimates were being cut their worst at 5.5%. Take a look as the market rallied there. Notice our earnings scores are all negative. That means the entire time estimates have been cut during this bull market. So if you've been waiting for estimates to start rising on an absolute basis, you've missed this entire bull market. And this is where I've been saying, if you follow absolute changes to the estimates, it leads to inferior conclusions. You've got to follow rate of change. The estimates were cut at lesser and lesser rates. There's the improving trends. And then you can see there towards the end, when it did diverge and the estimate trend started weakening, and this is even before Trump got elected president, you had that divergence happen. And that gave the warning sign for us to de-risk. And we moved to a 10% underweight stocks on February 1st to say, or February 3rd, actually. We said, start, warning, de-risking your portfolio. And particularly in the Mag 7, there was a lot of alligator jaws amongst, NVIDIA had an alligator jaw open big time with its estimates. Estimates were still going up, but at decreasing rates. So we de-risked. And now we're looking to see, are the worst of the cuts over? And that sets the stage for where we're recommending, where we recently did an upgrade here at the beginning of this month on stocks, because the jaw is closed and now we're starting to see the estimate cuts bottom. And every one of the major market bottoms, so we've had these alligator jaws that call the top. Every major market bottom has corresponded plus or minus 3 months to when the worst of the cuts are occurring, our earnings scores on a rate of change basis. In October there, you could see the worst of the cuts were occurring in third quarter reporting season of 2022, which peaks in late October, early November. That's when the majority of the companies are reporting their third quarter numbers. And the market anticipated that in advance and going, you know what, this earnings season, this is as bad as the cuts are going to be. And from here on out, the cuts are going to become less severe. And the market
Hmm.
does the price following that. The price does a very good job of predicting that the earnings trends were going to follow. And so that's why I like to marry the price movement and the earnings movement together to see if there's any divergences to exploit.
It's so, I mean, this is such a fascinating chart, Nick. And I mean, you hit on so many interesting things. I mean, that your basic premise at the beginning that it's not about the directional change in estimates, it's about the rate of change of it. And if you follow the absolute or sort of the, the trend in estimates, still pretty uncomfortably weak all through that bull market phase going into the peak in February of 2025. But the rate of change really showed how that evolves. And I really appreciate you showing that the alligator jaw. I mean, anytime you've mentioned it, that catches my eye, and I've followed it over the years. And again, I've never been disappointed with what that really shows. That there's an opportunity to sort of mean revert there. Let's talk a little bit about how the market has evolved since then, and talk about how things have played out from that sort of April low to where we're at today. And how have your expectations evolved since then?
So this is, first of all, this is why the job's open. This is the rate of change over the last year. So we're zooming in, if you will, on the period.
Yeah.
And you can see over the last, 3 or 4 earnings seasons, in peak earnings season, the estimates were cut at increasing rates. You can see that, minus 0.73%, then down minus 1.53% in second quarter 2024. Then you have third quarter reporting season in the fall, 2.05%. And then fourth quarter reporting season, as companies are reporting their fourth quarter 24 numbers, that peaks in late January, February, as companies report their annual numbers, and it was falling already 3.41%. And going in that, you can see that. Wow, if you look, the red line, we went to 61.14 all the way on the S&P. There's the alligator jaw. So you got the diverging trends of rising price, weakening earnings estimates. We go bearish. We go to a max, 10% underweight to clients at that point. And keep in mind, at the beginning of the year, why is the market going higher? Well, the market's pricing in animal spirits. Trump's the most pro-growth president we're going to have. He's going to have tax cuts, less regulation. He's going to make everything favorable. And all of those factors are going to combine to just really boost and juice the economy. The market's pricing in. All the while, he also has tariffs in the background, and the outlooks from the companies are getting a little bit weaker, going, maybe it's not so good. So this is where the market was pricing in perfection, and we've been able to find a way to quantify that it's going on in that divergence. Now, this earnings season, though, we see that the worst of the cuts are going to be occurring back in February of this year during fourth quarter earnings season. And I got to say, the line in the sand, Dave, was when Trump did the pause on April 9th. Because prior to that pause, the early reporters, their estimates were falling further than that 3.41%. They were deteriorating big time. And if Trump would have kept those tariffs on, the global economy would have taken a major hit, and no really country would have been immune. No one wins a global trade war. That pause, since that pause, it was almost instantaneously, the outlooks became less bad. So keep in mind, we're rallying. The estimates are still falling. So people will still say bad things about the tariff. We're still going to get residual effects of it. But what Trump has done is outlaid that the worst of what could occur. And the market priced in a 19% decline off of that. So you don't need to see things suddenly where the estimates start rising on an absolute basis and go up. We just need to see continued less bad, and that we priced in the worst, and that the expectations on the economy are going to continue to get better. And this is why it's bottom. And again, the bottom and the rate of change to earnings estimates will occur about a month or two before the bottom in the stock prices. And we got to confirm for me to upgrade stocks to our clients to say it's safe to get in the pool. And I always view my job as an investment strategist, if you will, for the earnings scout, as a lifeguard. If I see the storm clouds coming, blow the whistle, get out of the pool. But as long as I see the delta to the estimates getting less bad because the trade war has been de-escalated, that says it's safe to jump back in the pool a little bit, and let's go back into stocks at your clients' normal allocations. And that's what we've done. So we were able to avoid some pain from February 19th to April 8th by following this data. And I always say this has made me look a lot smarter than I really am. And our clients use it because it's objective. There's no Nick Raich opinion. This is pure math. I do qualitative analysis, and I give my opinions of 30 years of looking at things. But the reality, I always tell people, my opinion, everything we're doing in the stock market is about the future. No one's crystal ball is 100% of what it's going to look like this summer or 2 summers from now. And the market's discounting that into today's prices.
Yeah.
But with this data, you can really make yourself get an edge in there. And we think we get an edge on the earnings front, at least for clients, to have them make more informed investment decisions. And like I said, that alligator jaw has been a warning sign. It's 7-0. And, at the beginning of the year, where I had good cartoon charts of Trump wrestling an alligator jaw, because Trump doesn't alligator jaw was undefeated. It was a heavyweight fight. So whether Trump threw that fight or not with the tariffs, doesn't matter. The alligator jaw is 7-0 over the last 4 years.
I love that analogy as the market strategist as lifeguard. That might be a first for me. I don't know if I've heard that before, Nick. I'll keep that one. Whistle, blow the whistle, get out of the pool. I'll take it. That's a great one. So we're sort of wrapping up, earnings season here now. I mean, and you showed a little bit of obviously how the rate of change has been improving off of the lows. As you sort of take a step back, take a deep breath, and process what we learned in this particular earnings season, what are sort of your big takeaways or particular areas of the market surprise to the upside or the downside? Like, what does the table look like as you sort of look forward to the next couple months here?
Well, without a doubt, the major story, tariffs. Tariffs were a bad idea. Now, I think the intent of tariffs, get better trade deals for the U.S., all for. Bring back manufacturing in the U.S., if only for a matter of national security, so we produce more goods here and not depend on other countries, all good. Yeah. Doing it all at once at the same time, bad. So I have clients that are registered investment advisors that manage money. A lot of them come to me with their stock portfolios of clients, and they get a new client come in and they have 40 stocks and they think all of them are bad. They think all of the stocks are bad, but they know they can't turn over 40 stocks for that client. It's going to create taxable events. And the other thing is, you may hate those 40 stocks, but you don't know for sure that they're all going to go down. So you can't sell all 40 stocks. And that was my analogy of what Trump was doing with the tariffs. He was selling everything all at once, and it was too disruptive. So you needed to be more targeted. What you do for those clients is you sell 2 or 3, 4 stocks of the biggest offenders, the ones that are the most extreme overvalued or exhibit the worst price momentum. You get those out first. Yeah. And I think that's the biggest takeaway that I got this earnings season. And whether Trump, people say, did he cave? Did he not? The market doesn't care. The market doesn't have emotions. The market only cares that the trade war did de-escalate and the outlooks improved. Yeah. And that allowed for stock prices to go higher. So that was the big takeaway, that tariffs would be, a major issue. And the other takeaway for me is a lot of people have come out and said, we're going to retest the lows. Yep. I think we now show that we have the Trump put in place. And by that, whether he caved or not, in late 2018, there was a trade issues with China, and we had a sell-off where an alligator jaw was open, by the way, in late 2018. And the market wasn't really selling off because of Trump's trade tensions with China at the time, but the market was selling off and he eased the trade tensions back. The market was selling off because Jerome Powell was hiking rates too much into a decelerating growth environment with weakening earnings expectations with an alligator jaw opening. And then he said he was going to do it 4 more times in 2019, and he didn't. He actually cut rates in 2019. Right. But Trump has shown, if the economy is going to roll over, and there's going to be too much turmoil, he will back in to save the economy. And I think that is a takeaway that we got here. So anyone that thinks that the tariffs are on a 90-day pause and he's going to re-escalate it, I think the markets are going to have in the back of their mind, he's going to re-escalate it, but guess what? He's going to back off at some point too. And I think they're always going to be in the mindset of investors at this point, because Trump has shown he's 2 for 2 at backing off. Yeah, right. It's so fascinating how I feel like the time compression in terms of how these headlines have flipped the market from very encouraging to discouraging and back and forth is pretty aggressive here. So just to finish off, Nick, I mean, as you look at the conditions now, there's been, a period where defensive areas of the market, looking at like healthcare, which obviously moving quite a bit now recently, utilities, other sectors of the market, performing quite well year to date. Gold stocks, for example, and growth stocks had sort of taken a back seat. Now, coming off of the April low, we're seeing a resurgence in a lot of those growth names
the Magnificent Seven technology, for example. In your work, what's the right sort of balance, or where are you seeing opportunities between offense and defense, between growth and value? Any sort of thematic plays within the equity space that stand out to you?
That's a great question. And our models favored defense over the whole year in terms of the sectors.
Yeah.
What we do is we're looking for the sustainable trend. And over the past month, the better revision trends short term are in the cyclicals, the Mag 7, the technology, consumer discretionary, all the things that were getting hammered earlier in the year during the market sell off. Our model, though, 1 month, we say that's not a trend. So we need a little bit more proof. Show us a little bit more in the revisions to really warm up on it. But what we're telling clients is, and that's just from the quantitative models standpoint, that we're using as an indicator. But if you want to jump out ahead of that model and you believe that we're going to sustain and that trend's going to go, you do the forecasting and go, you know what? This is a pro-growth environment from Trump. And if we've seen the worst of the tariffs behind us, and oh yeah, he has something, a wild card in his pocket too right now for earnings. Tax cuts. We saw how that played out in 2017 when the tax cuts came, when he lowered the tax rates from 35% to 21. He's going to take it from 21% corporate tax rates down to 15. That'll be about this is real easy math, about a 5% boost to S&P 500 profits. So if you want to get that earnings trend continue to improve, Trump has a wild card in his back pocket to put out there. So that should help get things back, as long as we don't attack all the countries at the same time again, which I don't think Trump will, because he saw how disastrous that could have been for the global economy.
Sure.
We should be set here for the stage that even though our model is going to wait for a better confirmation, we got a 1 month confirmation in the data that the cyclicals are going to do better. The market's not going to wait for the analysts to start changing those estimates. The market's going to predict it ahead of time. That's what the market's very smart too. That's why I always say, if you can combine what our research does on the fundamental earnings with good technicals, boy, you get 1 + 1 = 3.
I promise I did not lead you to say that at the end, Nick, but I'll take it. That's a beautiful, beautiful way of describing the marrying of analyzing price and sentiment and momentum with earnings. And certainly you've completely changed my thinking on earnings and recognize that the absolute level is less meaningful, the rate of change, and certainly the trend in changes in estimates, super valuable. Nick, this was awesome. Good to see you again. Thanks for bringing some really interesting charts, some thought-provoking ideas, and helping us debrief on the earnings environment in a volatile period. So say hi to Northeast Ohio for us, and we'll look forward to talking again soon. All right.
Thank you.
So I hope you enjoyed that interview with Nick. I definitely, years ago, he introduced that alligator jaw pattern, and I saw how quickly the market deteriorated soon after that pattern emerged. So when he made some noise earlier this year, going into the February peak about a similar pattern, it was definitely one of the many things that helped me, reinforced a bearish perspective at that particular time. I really love his comments at the end there, and I promise I did not, ask him to do that, but talked about looking at the trend in earnings and the trend in price. I often get people, sort of debating like what's more important, right? Looking at the fundamentals, what these companies do, their ability to grow earnings and grow revenues versus the charts, right? And price momentum and stocks that are, favored by investors where psychology or sentiment is more constructive. I think a savvy investor uses both of those in a thoughtful and deliberate way. And I think the way that Nick summarized that at the end was spot on. I would definitely never tell you to ignore earnings. We started off the conversation with a comment that price follows earnings. And I believe that's true. And especially over the long term, I think stocks trade to their fundamental valuations. I think that's a fair thing to say. For me, technical analysis is all about how we get from point A to point B. Even if this company is going to grow earnings, even if their estimates are being revised higher, the change in estimates is improving, as Nick would say. Price is the best arbiter of investor sentiment, and improving momentum tells you something's there. And thinking about that relationship in a meaningful way, I think, is the game for most investors. Really appreciated Nick's perspective. Thanks again to Nick Raich of the Earnings Scout for sharing some really interesting charts with us. Probably some charts some of you haven't seen before, and I hope you found that meaningful. If this sort of discussion was helpful, if you need help figuring out the technical side about how we understand price change and price momentum relative to these earnings expectations and how they change, our Market Misbehavior Premium memberships may be a great opportunity for you to upgrade your own technical toolkit. 3 great benefits to the premium membership. First off, you'll have access to all of our virtual courses like Flight School Behavioral Investing, where we talk to you about behavioral biases and what's happening between your ears. We talk to you about technical analysis and the tools and techniques you can use to better understand the world around you as an investor. Second, you will have access to all of our members-only reports like our weekly flight plan, where we look back at the week that just happened. We look forward at the week to come. We identify some key levels and patterns to look out for. Also, our monthly chart review, where we apply our proprietary market trend model to a series of ETFs and asset classes. Finally, you'll have immediate access to our members-only community. That's where you can ask questions. That's where you can learn along with a group of like-minded investors, asking about charts, asking about indicators, asking about news, and how that relates to the technical components. My goal is to help people make better decisions using technical and behavioral investing tools, and that members-only community allows me to help you along in your journey. If all of that sounds interesting, go to marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today. Always looking for more great guests for the Market Misbehavior podcast. Wherever listening to this, if you can leave a comment with who you'd suggest, and we'll be happy to take a look and see who else we can bring on the show. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts.